What is margin?
You only need to put up a percentage of the total investment to enter into a position. This amount is known as the margin requirement. When you trade other securities like stocks, trading on margin means you're borrowing funds from your broker. However, Forex trades can only be covered using funds in the investor's Forex account. Investors can't borrow funds to enter a Forex trade. If they don't have funds in their Forex account, they need to transfer funds before placing a trade. Forex margin requirements vary depending on the currency pairs and the size of a trade. Currency pairs typically trade in specific quantities known as lots. The most common lot sizes are standard and mini. Standard lots represent 100,000 units, and mini lots represent 10,000 units. Depending on your brokerage firm, you may also be able to trade Forex in 1,000 unit increments, also known as micro lots. Margin requirements can be as small as 2% of a trade or as large as 20%, but the margin requirement for most currency pairs averages around 3 to 5%. To understand how margin is calculated, let's look at an example using the euro versus US dollar pair. Say this pair was trading at 1.20 and an investor wanted to buy a standard lot or 100,000 units. The total cost of the trade would be $120,000. That's a lot of capital. However, the investor doesn't have to pay that full amount. Instead, she pays the margin requirement. Let's say the margin requirement was 3%. 3% of $120,000 is $3,600. That's the amount the investor needs in her Forex account to place this trade. This brings us to another key element of the Forex market: leverage. Leverage enables investors to control a large investment with a relatively small amount of money. In this example, the investor is able to control $120,000 with $3,600. The leverage associated with currency pairs is one of the biggest benefits of the Forex market, but it's also one of the biggest risks. Leverage gives investors the potential to make large profits or large losses. One more important element in the Forex market is financing. This is the calculation of net interest owed or earned on currency pairs, and it happens when an investor holds a position past the close of the trading day. The US dollar is associated with an overnight lending rate set by the Fed, and this rate defines the cost of borrowing money. Similarly, each foreign currency has its own overnight lending rate. Remember, when you trade a currency pair, you're trading two currencies against each other. Even though the currency pair acts like a single entity, you're technically long one currency and short the other. In terms of financing, you're lending the currency that you're long and borrowing the currency you're short. This lending and borrowing occurs at the overnight lending rate of each